Hi, Steve Van Metre here, and welcome to your Wednesday night premiere. We take about 15 minutes every Monday and Wednesday night and try to make sense of markets. Look, how can they make sense when you have computer programs that are reading tweets and news and trading it within microseconds on this? It doesn't make any sense, but I think at a certain point when people figure out that computers don't just trade the markets higher, but eventually will trade the markets lower, that they'll be ready for our computer overlords to go away. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. Material is not to be construed as recommendation or solicitation by or sell any security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. Opinions expressed in this video that I do not reflect the view of Alice Financial Advisors Inc. or Steven Van Metre Financial. So markets obviously up today on trade optimism. Why would you have trade optimism? Well, if there's an impeachment proceeding, and I'm by far not the person to ask about how all that goes, but I'm guessing it takes a lot longer than, most people believe if it were to happen. But let's just say it was, and you're China, why would you bother negotiating? There's really no point, right? Hey, that guy may be gone. So maybe if he goes, so will all the tariffs. So of course, today, markets interpreted the news release to not be impeachable. Now, again, I have no opinion, didn't read it. I did try to catch some of the press conference, but I try to stay away from some of that stuff. And markets rallied then on hopes that, hey, we could have a trade deal. And President Trump tweeted no more than twice within 2 hours about how a trade deal with China could come very quickly. Who knows for sure? But we do know China is buying U.S. soybeans, and now they're going to start buying more U.S. pork products. And then the answer the media is giving is, oh, this is a olive branch. This is some goodwill. No, they're out of food. Which is kind of interesting to me, it's just like we have a strategic petroleum reserve, they have the equivalent strategic pork reserve, and that's how important pork is in China. So they have a store of pork for emergencies, and they're using it, and they need to get more. Well, who's got pork? Well, we do, and we've got quite a bit of it. Who's got soybeans? We do, and why is our soybeans of interest all of a sudden? Because Brazil's in a drought, and Argentina does not have the infrastructure to move its products quickly to port. Now, China is going to extend Argentina loans and whatnot to try to improve that, but that won't happen overnight. So for the moment, we're seeing a little bit of interest in ag commodities, and we'll take, of course, a look at that momentarily. Let me clear that off the screen. They still haven't fixed the problem showing the web browser in the window, but nevertheless, the Nasdaq McClellan Summation Index should be running out of steam here in terms of liquidity, and I will show you why that is. And let's take, since we were talking about crops, let's take a look at the 6 to 10 day outlook. Again, I am not your morning eyewitness weather caster or man, whatever he prefers to be called. I am not him, but I can read this chart. And so here we see a lot of cool weather coming. Again, my wife probably is very happy about this, as I'm sure some of you are as well. But we're seeing it start to push into the growing region. And the reason this is a concern is not during the day the temperatures are cool, but it's the overnight risk of getting a frost. And yes, they've got higher than average precipitation. Looking out over the 8 to 14 day. Now remember I said, and I did there was a video recently that I shared with you where someone who was by far more an expert on the details of this said, look, there is a recipe for late September, starting late September, to see a confluence that could bring colder weather down in the Midwest. And now here we are at the 8 to 14 day. We see colder weather coming down, and we see above average rain. Again, concerned because the late harvest isn't going to be harvested for several weeks. I think late October. So there is a potential frost could come in and hurt the crops, and farmers are already saying the little bit of rain, above average rain they're getting is a problem as well. Let's switch over to the charts. So while we're on the topic of ag commodities, let me get that fixed. Let's go and take a look at them. And what we see, a nice big move today is 0.96%. we're starting to see what is looking like the bottom here. I got people freaked out that this thing was going to zero. It's not. And then all of a sudden now we're seeing prices right here. Now from a technical perspective, all prices need to do is really push right above just this spot right in here. And all of a sudden you've got nothing but people who are short in front of you, and that should cause prices to move fairly quickly up to roughly about where the 200-day moving average is. And then it's got some congestion that it's going to have to work its way through, whether it will move back down and reconfirm a moving average or go higher. But we do know with each passing week now, we should get more data as the early harvest comes and farmers are reporting on it. Let's take a look at the S&P 500. Having no problem rallying back. Didn't quite touch his 50-day moving average today, but came into an area of heavy support and found buyers here. And sure enough, boom, it rallied back up. From a technical perspective, you can see it tried to get into, it pushed into resistance. You can see resistance is here and even way back here looking at the 10-day, and it kind of just fizzled out there. Now, part of the reason it did is we can take a look at volatility, which is, again, something you will never buy, sell, or even think about other than to your amusement watching me talk about it. But this is the volatility ETF, and you can see it came up to an area of resistance. So we know that the fact that it hit and stopped here means my purple line is correct. And as we look at the 10-day on this, you can see it came down today and went from resistance to support. So remember, this was resistance down here. Resistance has become support, which sets up potential move higher in volatility and lower stop prices. And if we zoom out, we can see this bottoming pattern start to reconfirm here. That tells us that at some point, unless it breaks through support and goes lower, we're looking at a lift-off event in volatility. Taking a look at 10-year Treasury yields, and again, this closes about a half hour before the market, so I didn't bother to look and see exactly where 10-year Treasury yields closed today. But what we do know is they're trying to fill this gap between Friday's close and Monday's open. And that's kind of why I've held off on the portfolio rebalance to give this thing a chance to kind of work itself out. We see the same true here with the 30-year yields trying to push higher, coming right up against its 50-day moving average, which has been a strong area of support. Resistance. I get those backwards sometimes. Strong area of resistance on the way down. So this is kind of right in that zone around 2.2% where I was looking to rebalance the portfolios. When we can confirm that looking at the short-term 1 to 3 year treasuries, which should be rallying based on the Fed cut. And it just goes to show the market is, once again, bullish inflation. So they're going to try to short yields or short treasury bonds to drive yields higher, not surprised. But there is still quite a bit of support. It kind of bounced off its 50-day moving average twice and is now down sitting in this support zone, which we'll look to see either a hold here or potentially even retest its 100-day moving average again. But I have a hunch that this is probably going to stay fairly close to here before it resumes its upward trend. And looking at the long bond, we can see that it's just a stone's throw away now from reconfirming a short-term support level and its 50-day moving average after bouncing off resistance at its prior all-time high. Not here, but going back to its prior all-time high. Again, I'm not surprised here that when it crosses through, when resistance, which is here, it then becomes support. So it's normal for markets to come up, test this, see if there's any interest to drive bond prices higher. There wasn't much, so maybe the buyers are waiting for prices to dip a little bit or letting the sellers exhaust themselves. So no surprise, sellers came in today, and we'll see kind of how much ammunition they've got left in their quiver. Dollar is starting to move higher, closed at 99 today. Zooming back to the big picture on the dollar, it's looking like it's going to hit 100 potentially pretty soon. And believe me, I can tell you, corporate earnings and profits don't want to see it. This could be the beginning of the unwind in the market, not to mention the timing of a breakout in the U.S. Treasury bond market, which is the final signal for the end of the market. But this would kind of match that Wyckoff topping pattern. It says this needs to get a little bit higher up here into this $150.50 range on the DXY, and that should signal the end of this, a rollover into the dollar headed down, which would be your catalyst for gold, because gold is massively overextended here. As we look at gold futures, it is just way off the chart. The speculation in the futures market is at extremely high levels, and that's not where you want to be chasing gold. So if the dollar starts to rally, we should get a big pullback in gold. And at that point, the Fed would be back doing quantitative easing. And based on the relationship between the price of gold and the money multiplier, that would be where you'd want to buy gold. So bonds first, then gold. Keep that in mind. That would be the move. And looking at gold miners today, you can see the junior miners down 4.5%. Again, this is looking very clearly like a topping pattern that should bring this lower, create the big buying opportunity when the dollar rolls over and heads down. Looking at emerging markets from a liquidity standpoint, you can see it's forming a series of lower highs. And when it breaks this shaded line is when liquidity in the markets gets really ugly, and that is usually predicated by a rally in treasury bonds. So we should expect, based on this price action, to see emerging markets come back down and retest this to see if this is going to act as support or if it's going to break through and become resistance. Let's see what else we've got. Let me check how much time we've got. Okay. Let's take a look at crude oil. This doesn't update perfectly, but crude oil rallied back. Is still sitting in this symmetrical triangle. It had a false breakout, was reversed. Practically the entire Saudi missile strike or drone strike or whatever it turned out to be. Markets pretty much discounting that there's really no problem. We had 2 weeks of crude oil inventory build, although people are saying, well, because of storms, that this week's build will go away. We'll see. We did see a gas build as well. But what we know is if this is a sustained breakdown, that crude oil should head quite a bit lower. And along those lines, we can see oil and gas producing stocks, symbol XOP. This will be a big opportunity probably in 2 years, I want to guess. But anyways, it did fight back over its 50-day moving average after giving back again all of its gains since the Saudi strike, oil-filled strike. Again, tells us that crude oil price or oil and gas producing stock prices are headed lower first, not higher, because they have not had their major selling event yet. Some things of interest as we let's look at GE first. Looking to break down, we can see this is where a lot of the GE executives came in and bought stock. And you can see the market's kind of saying, thumbing their nose at those people and saying, nah, we don't think the stock is worth that. And again, if GE breaks through this, just below this roughly $9 range, it's not a pretty picture, because it suggests that GE stock is once again going to get a head lower and need the bailout of its corporate executives if they have money left to prop the stock price up. Netflix, which has been a leader, remember the FANG stocks, Facebook, Amazon, Apple, Netflix, and Google. I'm adding Apple or Amazon to that. I forget which one wasn't in the original FANGs. But nevertheless, when you see one of the former leaders give itself up, and you can see it's way down off of its all-time high, whereas the NASDAQ is still sitting way up here. And you can see Netflix is headed lower. And from a technical perspective, it's got some support right into here where it bounced off of. But when this gives away, it's got a gap here, and it's got a gap way down here. Netflix could be one of the things that cast this market way, way, way lower. So let's kind of wrap things up here. A lot of people aren't thinking about, you've heard me say time and time again, it's going to be one of the worst recessions. You have these really long expansions, you have these really big inventory builds up, but there's other things that people are completely discounting. And what I mean by that is all the companies that aren't making any money. I mean, here's a perfect example, Tesla. Nothing personal against them, but in 15 years, the only quarterly profit they've shown was not from selling cars, but from selling carbon credits or green credits or whatever they get because they produce electric vehicles. And they sold them, and that was how they made money. Take companies like WeWork, who go out and establish long-term leases on office leases and then do short-term short-term leases against that. These models just aren't working. And the whole point of recessions is, look, Elon Musk, if you can't make the car industry profitable, then your business needs to go into bankruptcy. Let the bankruptcy court, get the debtors paid off, and then, essentially auction off or sell off all that equipment at a lower value and let someone else come in and try to do it. That's kind of how the system should work. We should cut recessions are not just about inventory build, they're about cutting out the dead wood. And there's a lot of companies, not just Tesla, not just WeWork, Uber, Lyft. I mean, there's a long list of companies that aren't making any money, and they need to, because the Fed is not handing out money anymore, or at least it's not working. And I can't wait to see tomorrow's data update on the monetary base to see if the last rate cut worked. But so far, we have 2 rate cuts, no new all-time highs in the stock market. I'll see you Friday. I'm Steve Van Metre. Bye now.